Hello everyone, welcome back to my channel. Price earnings ratio is one of the most commonly used valuation measures for stocks. So, what exactly is the price earnings ratio? It is obvious from the name that it is price divided by earnings. In simple language, it is the amount of money you are willing to invest in a stock for every rupee it earns at the moment. Say for example, the current market price of a share is rupees 100. Its earnings per share is rupees 20. Then it means that for current earnings of rupees 20, the market is willing to pay rupees 100 and the price earnings ratio of the company is market price divided by earnings per share, that is 100 divided by 20, which is equal to 5. This implies that the market is willing to pay 5 times the current earnings of the company at this point for its future earnings and growth potential. Now that you all know what is price earnings ratio, let us dive deeper into its interpretation and usage. It is considered that higher the P ratio, more expensive the company is. However, investing just on the basis of a low PE could lead to incorrect investment decisions. You should never look at the P ratio of a company individually. P ratio is a relative valuation measure, which means that you have to compare the P ratios of different companies to draw conclusions. You should also compare the P ratio of a company to the industry PE. Industry PE is the average of P ratios of all the companies in the industry. If a company is trading at a P ratio which is higher than the industry PE, then it means that it is relatively expensive. But before you make your decision, you should ask yourself, why is it more expensive? The reason could be that the company is the market leader and has a proven track record. The company's growth prospects are very good and market expects it to grow at a faster rate than its competitors. Also, the management is very good. If this is the case, then it is justified to buy a company at a high PE ratio. Say for example, a company is trading at a PE ratio of 100. This is considered very high. However, if it grows very fast and its profit doubles in a year, then the PE ratio, which is market price divided by earnings per share, will halve from 100 to 50 because the earnings per share will double. So in such a case, if the PE ratio of a company is very high but it is growing very fast, then it is okay to buy it at a high PE. Now coming to low PE stocks. If a company is trading at a low PE, then it means that it is cheap. But before you become happy for finding a hidden gem, you should ask yourself, why is it cheap? Is the company's growth not good? Is the management not honest? Does the company have very high debt? If there is no such problem and you like the company's business, then such a company could be a very good investment. However, if the company has such problems, then there is a reason why it is trading cheaply. You should think twice before investing in such a company. Also, P ratios are not very useful while analyzing cyclical industries. A cyclical industry is an industry that does very well during times of prosperity, that is, when the economy is booming. However, they struggle a lot during times of recession. Their earnings are very volatile, that is, they fluctuate a lot. Take a car manufacturer for example. During times of prosperity, a lot of cars will be sold. The earnings of the company will rise significantly, and due to this, the P ratio of the company will become lower. Now, next year, the economy might not do very well, and the earnings of the company fall down significantly. So, if you invest in a cyclical company during an economic boom, then the P ratio of the company will be very low because the earnings per share will be very high. However, if the economic scenario deteriorates, then the earnings per share of the company will fall down significantly and the stock that you invested in, considering it a low PE stock, will suddenly become a high PE stock due to the fall in earnings per share. So, it is better to ignore PE ratio while analyzing cyclical industries due to the volatility and fluctuations in price earnings ratio and earnings per share. If you liked this video, please give it a thumbs up, subscribe to my channel for my upcoming videos. Also, do share it with your friends and family who might be interested in finance. Stay tuned. Thank you.